Trust the Plan podcast. I'm Nick.
And I'm Jim.
And Jim, at Peak Wealth, we believe by providing education and guidance, we can help our clients make great financial decisions so they can retire with peak confidence.
That's very true.
Yes. And we have an exciting milestone we just reached. I'm sure all of you will be really excited to hear that we just crossed over 400 million in assets under management. So, we're excited. It's kind of a big deal for us. I'm sure you're jumping out of your seat. But last month we talked about Jim being partner, and I was looking back at the numbers back in 2018 when Jim joined us. We had about 100 million in assets under management. So it's been a pretty good ride here the last 7 years.
It has been, yeah. Market's helped, and we've just, I feel like, really hitting our stride with new clients and prospects and referrals. You guys have done a great job referring great people to us, so we appreciate that very much.
Absolutely. So it's here the first week in July, so the first half of the year is over. So a little bit of a halftime report as well. We saw a lot of volatility in the first half of the year with the tariff tantrum, as you all know. We actually had a 21% drawdown, as you can see on this chart here if you're watching on YouTube, from February to early April, minus 21%. We had a little bit of a shaky March, but then really the bottom fell out in early April.
Yeah, we had a couple really Liberation Day in April, really gave us a pretty bad few day stretch there that caused a lot of uncertainty, a lot of panic even for some folks.
It was a lot of panic. And then I believe it was April 7th or April 8th when Trump tweeted, now would be a great time to buy. Then a few hours later, they said they're going to do a 90-day pause, and it really just took off after that. 28%, this is as of June 27th, and now here we are recording July 1. It's even higher, but we did reach a new all-time high on June 27th. So the figures for the first half of the year, so Q1 plus Q2, the S&P was a little over 5% positive, same as NASDAQ. The Dow was a little behind, plus 3%, but international, plus 20%, emerging markets, plus 16%, and fixed income, the aggregate bond index, plus 3.5. The only black sheep for the first half of the year was small caps, which were minus 2% on a year-to-date basis.
Yeah, it's kind of proven to be a year that we're happy we're diversified. We're glad we're spreading it around because we're getting a lot of help from a lot of the other sectors. It's been U.S. large cap for so long. It's nice to get some participation from some of the other styles.
And most of the strategists that we talk to think that the international can continue to outperform, not just because the stocks are undervalued relative to the U.S., but also because of a falling dollar. So as we own foreign assets and the dollar goes down, we're translating those assets back into dollars. It results in more dollars. So in fact, I believe if you look at the international local currency, it's more like plus 10. Don't quote me on that. But when you factor in the dollar declining, it is plus 20.
Yeah, I think that was a really great takeaway from our halftime report the other night, where he talked about that and showed how the falling dollar has really helped the international assets. So it's really been a place that we want to be, not just because they are in position to perform, but because the currency's helping quite a bit. And
so when we think about the way that we got here, there's a great piece on Twitter from Dietrich that I don't have pulled up here, but it says at some point during the first half of the year, if the S&P is minus 7%, but then it finishes the first half of the year positive, there's not that many times that this has happened. It's a small set of outcomes, but the average return for the second half of the year, when this type of activity happens, is plus 5%. But if it's a year where there is no recession, then the average return for the second half of the year becomes 11%. So either way, right? I don't think that we'll have a recession. That's my crystal ball. Not this year anyway. But even with the recession, it would be 5 plus 5, right? And without the recession, 5 plus 11. Either way, it turns out to be a good year.
Yeah.
And so that's when we're thinking about the S&P. When we're thinking about fixed income, about 3.5% year to date, which is a 7% annualized clip. And we've been talking about fixed income and the possibility of making 5 to 6% per year for the next 5 years. So the first half of the year, a little bit ahead of that pace.
Yeah, and there's been a lot of talk about rate cuts, right? It's a hot topic, whether we need them, whether we don't. Administration's pushing for them. So we'll see what happens on that. But if we see rate cuts on the bonds, that should help the value of the bonds go up and could continue to be a good place to be.
I agree. And so as we also think forward, we have the 90-day tariff pause expiring. And there's a few deals that they made and many that have not been. But I feel like it was all about, my personal opinion is that it was all about China from the very beginning, and that deal is done. And so I think that this is largely behind us.
Yeah, I don't think the market's worried about, our trade deals with, tiny little countries and stuff. It's the big one like, China and, some of the European countries and stuff. So I agree.
Yep. And also you wouldn't see the market hitting new all-time highs right ahead of a big worrisome moment. So I don't think it's worried about it at all.
Yeah, I think the market has definitely, digested the tariff talks and has a little more certainty on where they think, Trump and the administration is going with it. So I think that's why we've seen a real rebound in the market.
I think also the market anticipates the tax cuts, that bill getting, the big beautiful bill getting passed with the tax cuts. The part that's really disappointing is the continued spending. That's extremely disappointing to me, but I do like tax cuts, but I want the pair together,
Yeah.
Okay, so that's our little mini halftime report here. We have a great halftime report every year at Fox Hills with one of our investment partners. Like last night it was Vanguard, last year PIMCO, the year before JP Morgan. So you should, if you're interested, you should definitely mark your calendar for next year for our halftime report. If you'd like to learn more about working with us, you can schedule an appointment online at peakwm.com.